Welcome to the Before AGI podcast. This is our first deep dive in what I think is a really crucial five-part series. We're tackling that big question everyone seems to be asking right now, whether you're an investor on a board or just, deeply curious. Is this AI market surge real sustainable growth, or are we just heading into another massive speculative bubble?
It really is the essential question today. And to get anywhere near an answer, we have to look beyond the daily headlines, the hype. We need to apply some historical perspective.
Yeah.
So our goal today is to take patterns from past manias, think tulip mania way back,
Sure.
or the dot-com bubble more recently,
Right.
and see how they stack up against what's happening in AI right now.
Oh, okay. And we're framing this using the definition from economist Robert Shiller, right? He
Yes.
talks about bubbles.
Exactly. For Shiller, it's not just that prices are high, that's part of it, but it's really this cycle.
A cycle.
Yeah, where rising prices fuel investor enthusiasm.
Yeah.
And that enthusiasm spreads almost like a virus. He calls it psychological contagion. And this contagion amplifies the stories people tell themselves to justify the prices until, well, the actual fundamentals barely matter anymore.
It sounds familiar.
It should. What's fascinating, really, is how consistent this playbook is across centuries.
Yeah.
Speculative bubbles aren't some weird historical quirk.
They're baked into the system somehow.
You could say that. The economic forces, the psychology.
Mm-hmm.
It's remarkably similar, whether you're talking Dutch tulips or, AI kips today. If we can understand that blueprint, maybe we can handle the risk better.
All right, let's get into that blueprint then. Where does it start? What are the preconditions?
Sure.
The fertile ground, as you put it. What's the financial fuel needed?
The fuel, fundamentally, it always comes down to easy money. You need lots of liquidity sloshing around the system, usually combined with low interest rates.
Makes sense.
Yeah, Axel Weber, former head of the Bundesbank, pointed this out. When central banks flood the market and keep rates low, that money has to find a home.
And safe investments aren't paying much.
Exactly. So capital flows towards riskier assets,
Yeah.
chasing higher returns. That's step one.
And that easy money, it gets amplified, doesn't it? By credit, by leverage.
Oh, absolutely. That's the dangerous part. Think back to before 2008. The amount of mortgage leverage was just staggering.
Right.
When asset prices are going up, could be stocks, could be houses, they look like great collateral, so people borrow more against them.
Which pushes prices up further.
Precisely. It's a self-reinforcing cycle. Creates this upward spiral, but builds incredible fragility into the whole system.
Okay, so that's the financial kindling. But you also mentioned needing a story, a narrative, the kernel of truth.
Yes, that's crucial. Usually it's a genuine technological revolution, something truly new and exciting that makes the wild optimism seem, well, plausible.
And this is where Carlota Perez's work fits in. The cycles she identified.
Exactly. She studied 5 major tech revolutions over centuries. Steam, railways, electricity, cars, IT.
And found a pattern.
A very clear one. It starts with the eruption of the new tech. Then comes a speculative frenzy, often fueled by that easy money we talked about.
Okay.
That frenzy eventually leads to a crash, a recession. But after the crash, you get what she calls the golden age, where the technology is actually deployed widely and productively.
Can we see that pattern in a specific historical example?
Oh, definitely. Take the British bicycle mania.
Yeah.
Sounds quaint now, right? But between 1895 and 1900,
Bicycles were cutting-edge tech then.
absolutely. They were revolutionary for personal transport.
Yeah.
Huge potential. But combine that real innovation with easy credit.
Yeah.
Share prices for bicycle companies went up over 200%, then collapsed by more than 75%.
Wow. So the tech was real, but the valuation got decoupled.
Exactly. The innovation was transformative, no doubt.
Uh-huh.
But the market priced it as if everyone would adopt it overnight, which was unrealistic.
But hang on, is comparing 19th century bicycle manufacturing to, say, modern AI software really fair? The economics are so different, scalability, zero marginal cost for software.
That's a fair challenge. The underlying mechanisms are different. But Perez's point is more about the structure of the cycle. The new technology provides the powerful narrative, the kernel of truth, regardless of whether it's steel frames or algorithms.
So the bicycle mania is a warning about timing, about expectations getting ahead of reality.
Precisely. It shows how genuine potential, when mixed with loose money, can lead to that.
Yeah.
That irrational exuberance, it sets the stage.
Okay, so we have the financial setup, the tech narrative. Let's talk about the human element, the spark. How does psychology turn possibility into, seeming inevitability?
The psychology. This is where it gets really human. The main driver is just classic herd behavior.
Following the crowd.
Yeah, and it's powered by FOMO, Fear of missing out. We've all felt it, right? You see some stocks soaring, everyone seems to be getting rich.
And you feel like you're being left behind.
Exactly. That feeling can easily overwhelm any rational analysis of valuation or risk. It's incredibly powerful. The CFA Institute actually found herding is the single biggest behavioral bias impacting investment decisions.
Wow. And this FOMO, it gets amplified by other biases, cognitive errors.
Oh, definitely. They work together. There are three big ones usually at play in a mania. First, confirmation bias.
Where you only look for information that confirms what you already believe.
Precisely. You actively seek out the good news, the article saying AI will change everything, the stock will double again, and you dismiss the skeptics.
You just don't get it.
Right. You tell yourself they don't understand the new paradigm. Then there's overconfidence bias.
Thinking you're smarter than the market?
Basically, yeah.
Yeah.
Overestimating your own ability to predict the future, to know exactly when to sell before the crash. History shows almost nobody pulls that off consistently.
And the third?
Anchoring bias. That's where you focus too much on recent price action.
Like if a stock just doubled, you assume it'll double again.
Yeah, you anchor your expectations to those recent dramatic gains and just extrapolate them forward indefinitely. You forget that trees don't grow to the sky.
So these psychological traps are powerful on their own, but then you add institutional factors that kind of pour gasoline on the fire.
That's a good way to put it. The system itself has incentives that accelerate the excess. Let's talk about venture capital.
Institutional FOMO.
You could call it that. The whole VC model is intensely competitive. They're all hunting for that one unicorn, that next Google or Amazon.
So they have to place bets, sometimes big ones, early on.
Exactly. And that drives aggressive valuations, especially in hot sectors like AI. Look at the numbers for 2024. Almost a third of all global VC funding, over $100 billion, went into AI startups.
$100 billion.
And those AI startups were getting seed valuations that were, on average, 42% higher than non-AI firms.
But couldn't you argue that's just rational foresight? That the VCs see the genuine massive potential of AI?
You could argue that.
Yeah.
And there is genuine potential. But the sheer speed and scale of that valuation jump suggests something more is going on. That competitive pressure inflates prices, which then validates the boom narrative, pushing valuations even higher. It feeds itself.
Okay, what about other incentives, like how executives get paid?
Right, executive compensation. Very often it's heavily tied to short-term stock performance.
So they're incentivized to boost the share price now, even if it's not sustainable long-term.
Exactly. It can push leaders to prioritize actions that fuel market hype, big announcements, aggressive forecasts over perhaps duller but more sustainable long-term strategies. We saw a lot of that during the dot-com bubble.
And wrapping all this up is the media narrative.
Narrative dominance, yeah.
Yeah.
Financial media, social media, they thrive on big, sensational stories. Stories about trillion-dollar companies and world-changing tech get more clicks than cautious analysis.
So skeptical voices get drowned out.
They often get marginalized. It creates these echo chambers where the "this time is different" mantra just gets repeated and amplified. The story of AGI potential becomes, in a way, more real than the current quarterly earnings report.
It becomes the dominant truth everyone accepts.
Pretty much.
Okay. So we've laid out the potential ingredients, the easy money, the compelling tech story, the psychological biases, the institutional pressures. Now for the crunch time. Diagnosing the mania. Let's apply this framework. What classic bubble warning signs are flashing right now as we speak in late 2024, early 2025 in the AI market?
Well, the first one you absolutely have to look at is market concentration. It's extreme.
Meaning the market gains are driven by just a few big stocks.
Very few.
Yeah.
You have the so-called Magnificent Seven tech firms. They now account for over a third of the entire S&P 500's market cap.
A third from just 7 companies.
Yes. And that level of concentration, it's literally twice as high as the concentration we saw among the top tech stocks back at the peak of the dot-com bubble in 2000.
Twice as high. That sounds risky. Systemically risky.
It points to vulnerability, absolutely. And then, of course, there are the valuations themselves.
They seem pretty stretched.
To put it mildly, if you look at a key player like Nvidia, its forward PE ratio hit something like 50x in late 2024. That's pricing in enormous future growth.
But it's not just Nvidia, right? It's broader.
Yes, and that's maybe more concerning. We need to look at the KPE ratio.
Okay, remind us, what does the KPE ratio tell us?
So KP stands for cyclically adjusted price-to-earnings ratio. It's useful because it smooths out earnings over 10 years, so you're not just looking at one good or bad year.
It gives a longer-term perspective on valuation.
Exactly. And the KPE ratio for the broader U.S. market is currently hitting levels around 40.
And how does 40 compare historically?
It's territory we've only really seen twice before, right before the 1929 crash and at the peak of the dot-com bubble in 2000.
Wow. Okay, so that's sobering.
It suggests enormous optimism baked into prices. A KP of 40 basically means investors are willing to pay a price that would take, theoretically, 40 years of average past earnings to recoup. Huge faith in the future.
Which ties back to that narrative dominance. Old valuation rules don't apply anymore.
Right. And another big signal, maybe less obvious, is the shift in capital expenditures, CapEx.
You mean how much companies are spending on infrastructure, buildings, equipment?
Yes. The tech industry, especially software, used to be praised for being asset-light, low CapEx, high margins.
But AI changes that.
Completely flips it. AI is incredibly capital-intensive. Building the models, running the data centers, it requires massive investment.
And we're seeing that spending now.
On an unprecedented scale, the numbers are staggering. Microsoft is talking about $80 billion in CapEx for fiscal 2025, mostly AI-related data centers.
$80 billion.
It's
1 year.
Yes. Meta's projecting up to $40 billion.
Right.
Amazon AWS, maybe $75 billion. These are mind-boggling sums.
That $80 billion from Microsoft, I mean, is that a sign of confidence, like they know they'll win? Or is it almost panic spending, trying not to fall behind?
It's probably a bit of both. And it feels very bubble-like. Remember 2000? Companies spent fortunes laying fiber optic cable across the globe.
Building the infrastructure for the internet age.
Right. The infrastructure was needed, eventually, but they built way too much, way too fast, ahead of actual demand. Led to bankruptcies, massive write-downs.
And the risk today is similar, but maybe even faster, because the tech changes so quickly.
That's the key difference. Those fiber cables are still useful.
Great.
But today's AI chips, the models, they could be obsolete in 18 months. So spending $80 billion, which is like the entire GDP of a small country.
On infrastructure, that might be outdated soon.
It suggests a real frenzy to stay ahead, a deep speculative bet on maintaining that computational edge. It's a huge gamble.
Okay, so concentration, valuations, CapEx.
Okay.
It sounds pretty bubbly, but is it all hype? Are there factors pushing back, things that make this different from, say, .com?
Yes, and this is crucial. It's why just calling it a bubble might be too simplistic. There are important differences. The biggest one, profitability.
Unlike the .com era, where many high-flying stocks had zero revenue, let alone profit.
Exactly. Many .com companies were literally just ideas with billion-dollar valuations. Today's AI leaders, Nvidia, Microsoft, Google, Meta, they generate enormous revenues and profits.
Real businesses underpinning the hype.
Yes. Nvidia, for example, booked nearly $30 billion in profit on over $60 billion in revenue in 2023. That's a real substantial foundation that simply didn't exist for most companies in 2000.
And the technology itself, it's actually being used, right? It's not just vaporware.
Good point. Adoption is real and growing. One survey showed business adoption of AI jumped from 55% in 2023 to 78% in 2024.
Though companies are still cautious.
They are. Concerns about reliability, security, how to integrate it properly, those are real hurdles. And that caution actually acts as a kind of natural brake on pure runaway mania. The tech is being deployed, but maybe not quite as fast as the stock market expects.
And another difference might be there isn't universal agreement this time.
Exactly. There's still significant debate among serious analysts and investors. You have credible voices, people at Goldman Sachs or the CIO of Alliance, arguing this is more of a boom underpinned by fundamentals than a pure bubble.
So that lack of universal euphoria is actually a counter-indicator.
It helps. In past manias, near the peak, almost everyone agrees prices will go up forever. The fact that there's still healthy skepticism prevents that final dangerous stage of uniform belief.
Okay, this leads us to the conclusion then, the verdict. Given this mix, real profits and adoption on one side, but extreme valuations, concentration, and CapEx on the other, how should we think about the AI market today?
I think the best description, based on everything we've discussed, is a fragile boom.
Fragile boom, meaning?
Meaning it's a period of genuine, important, potentially transformative technological progress. That part is real. But it's become dangerously intertwined with clear speculative excess and, frankly, sky-high expectations.
And that combination creates specific risks for people trying to navigate this, for you, the listener.
Yes, very specific risks. We can probably boil them down to three main areas. First, what I'd call the time horizon mismatch.
The market pricing things in too quickly.
Exactly. AI is likely a multi-decade transformation, like electricity or the internet. But the market seems to be pricing it as if all that change, all that profit growth, will happen in the next few years, maybe even quarters.
Which is unrealistic.
Historically, yes. If the earnings growth, even for the leaders, doesn't meet those incredibly aggressive, compressed timelines, we could see a major valuation reset.
Okay, risk number one, time horizon. What's second?
The capital intensity concerns we just talked about, that massive CapEx.
The $80 billion question.
Right. Unlike traditional software, this AI infrastructure requires constant, huge reinvestment. Can these companies generate sufficient returns on that capital before the next generation of chips or models makes it obsolete?
The speed of obsolescence is the killer variable there.
It makes the returns incredibly uncertain. It's a very different business model than asset-light software.
And the third risk.
Winner takes most dynamics. Or maybe winner takes almost all.
Because the market concentration is so high.
Yes. The valuations suggest investors believe only a tiny handful of companies, probably the big foundational model builders and infrastructure providers, will capture the vast majority of the economic value created by AI.
So if you're invested heavily in companies further down the chain, the application layer,
You face significant risk. Many of those companies might have high valuations now based on the overall AI hype. But if they don't emerge as one of the few dominant players in their niche, they could face a brutal correction when the market gets more discerning. That $100 billion in VC money, it might be rational for the top two winners, but disastrous for the next 50 also-rans.
So pulling it all together, the same forces, economic, psychological, institutional, that inflated past bubbles seem to be very much at play today in AI.
They clearly are. The challenge isn't just predicting a crash, it's figuring out how to navigate this period, this fragile boom, without getting completely wiped out by the volatility.
But there's a final twist here, isn't there? Sometimes these bubbles, even though they burst destructively, leave something valuable behind.
That's the fascinating paradox. Historically, these periods of speculative frenzy often financed the build-out of transformative infrastructure that more cautious, rational capital might avoid.
Like the canals, the railways.
The fiber optic networks from the dot-com boom, a lot of that infrastructure, built with bubble money, formed the foundation for the next wave of growth, for Perez's golden age.
So the bubble, in a weird way, can be productive, even if it's painful for investors caught in the collapse.
It can be. It accelerates the deployment of the new technology's infrastructure.
Which leaves us with a really provocative thought, doesn't it? The question isn't just if the hypervaluation corrects, but whether we, understanding how these bubbles work, can somehow manage the inevitable downturn.
Mitigate the collapse.
Yeah, mitigate the collapse in a way that preserves the useful stuff, the infrastructure, the innovation, so we can actually get to that productive golden age faster and maybe with less pain this time around.
That's the trillion-dollar question, isn't it?
It certainly is. And if you want to keep exploring challenges like this one, thinking about AI and its trajectory, make sure you subscribe to follow the next 4 deep dives in this series. This has been episode 1 of the Before AGI podcast. And for more AI tutorials and insights, check out my YouTube channel, Ian Ochieng. That's OCHIENG AI.